Hey guys, welcome back. Before we get started on chapter 14, I wanted to just dive in a little bit more about my family and my personal background because I know that with online courses, there can be a bit of a disconnect. I'm not always showing my face on video either. I try to do that a little bit more, but not today. These are some pictures of my son. He's in his second year at Texas State University. Go Bobcats. If any of you guys are thinking about transferring, business majors are able to transfer the credits. I think you need 14 hours at ACC to be able to be guaranteed transfer. There's a Bats to Cats program. If y'all are interested, then send me an email. I can send you some more information or direct you to a link where you can fill out the form to get started learning more about that. Okay. My second son, Colin, he BMXs, he skateboards. There's the pictures, some of the pictures are a little old. He's 17 now, and he's a junior in high school. And then my little Lotta is going to be 5 in November. She does ballet, she does gymnastics. She's a very happy little girl, and she loves taking pictures. So this is my family. This picture is also a little bit old. As you can see, Lotta is behind my husband's head. She's a tiny baby, and now she's almost 5 years old. But my family's growing up. The tiny girl in the next to me, she is now at Sam Houston State. She's in her second year as a Bearcat up there. So. All right, let's get into chapter 14, Understanding Accounting and Financial Information. This is one of my favorite chapters just because it's, I would say, one of the more useful ones. Again, we're just brushing the surface of a foundation in accounting, but there's a study guide attached to this. This is what you will submit as your next assignment. And, we also have some videos complementing it, which I will refer to later on in the chapter. So, what are our learning objectives? We'll talk about what accounting is and how financial information is useful to stakeholders and to the future of the business. We'll talk about the different steps in the accounting cycle, distinguish between accounting and bookkeeping, and talk about the role that computers are increasingly using in accounting. We'll talk about some of the major financial statements, and one of the reasons why I'm putting chapters 14 and 15 first, even though they come at the end of your textbook, is because they'll be incredibly helpful to you when you begin your stock project. So we'll identify three disciplines within the accounting profession. Start off by talking about what accounting is. So basically, accounting includes recording, classifying, summarizing, and interpreting financial events and transactions. They provide management and other parties information that they need to make good decisions. So accounting is essentially keeping track of your financial transactions and events that have an impact on your business. Some examples are listed below. They could be buying and selling, goods and services, so your daily transactions, acquiring insurance, which incurs a fee, paying employees salary or benefits, and the purchase and use of supplies. This could be larger assets, which you can depreciate over time, or smaller assets, which would be a transaction in the time that they occur. So it's not just accounting's not just useful internally. There are also external stakeholders that are interested in the performance of the business. So for publicly traded companies, they need to use generally accepted accounting principles or GAAP principles. These are rules that have been outlined by the United States government, which um, which explains how these companies need to prepare their financial statements. It talks about the way that they need to record transactions, when they're able to recognize revenue, and when and what expenses need to be recognized. This also outlines that when companies begin to use a specific method under GAAP, that they need to continue to use that method to allow uniformity of financial statements and reporting. So the accounting system. This is a general outline. We have accounting inputs. So we have different transactions or events that occur that are reflected in the finances of the business, right? So those inputs are what we're going to put into our accounting system. Then those inputs will be processed, and we create something new that is unique to the business, which is the output or financial statement. So inputs, examples of inputs could be sales documents, purchasing documents, records of payroll, bank receipts or transactions, travel records or other expenses or transactions through the business. So all of those raw accounting documents by themselves are a little bit overwhelming to decipher. So we need to process these. We need to turn these into something that makes sense. So we'll put these entries, we'll make entries into journals. So we'll take the raw documents, we'll extract the cost information, and we'll add them into journals. Then we'll transfer them into ledgers. And finally, we'll summarize and review to complete a trial balance. So we'll get into a little bit more about what that means in later slides. But once those documents are processed, then we can create the output. We can create our balance sheet, income statement, statement of cash flows, or other reporting that's necessary for the company. So the textbook outlines some occupations that you can use with an associate's or a bachelor's degree in accounting. So accountants tend to deal with specifically cash management and forecasting. Some are more interested in market strategy and planning, and this could be the stock market, this could be public or private markets, um, personal financial planning. There's a CFP certification for that. Some are specific to valuations, or M&A or mergers and acquisitions. And the vast majority, the vast majority of accountants deal with tax and auditing. So these types of services can allow companies to have more visibility into their processes. They can create efficiencies. They're able to dive into manufacturing, costing, which can relate to headcount, waste, scrap, non-conformance, and downtime. Downtime is your when your manufacturing line isn't running, it's just idle time where it's using resources, but it's not creating an end product. So who uses these accounting documents? Governments require them. They want you to pay your taxes. The IRS wants to know at the end of the year and also quarterly. A lot of businesses need to pay quarterly sales tax if you fall under that category. There are other regulatory agencies that require those kinds of reports. People interested in the company's financial position. For example, if you want to get a loan to grow your business, they'll want to see that the company and its operations are financially stable. Analysts or suppliers, if you want to get credit through a supplier, they may want to know how your business is running. They may request certain financial statements as proof. And or if you want to be a supplier to a larger company like Walmart, for example, then they'll want to know that the company has a track record of on-time delivery, of supplying, of having positive cash flows, which we'll get into more later, and have let's see, and yeah, that's pretty much for that. So The most important point of using accounting information to influence decision making is to make sure you have the right information at the right time and in the right format. All right, we'll get started on the accounting cycle. The accounting cycle traditionally relied on a bookkeeper and an accountant. The bookkeeper's role was to take those basic documents and post them into record books or journals in order to catalog the expenses by type. Nowadays, the bookkeeper, it can be completely automated. You have apps you can download on your phone, which can tell you how your expenses are tracking, well, either personal or business related. They can let you know how much you spent on clothing during the month or how much you spent on groceries. So that was the bookkeeper's kind of traditional role. Now, double entry bookkeeping is when you require two entries in the journal and then the ledgers for each transaction. That's the practice of writing every business transaction in two different places. Oh, sorry, I missed something. So, defining the accounting cycle. So, it is a six-step procedure that results in the preparation and analysis of the major financial statements. So, the accounting cycle is how you get from the raw transactions to the end financial statement. That is the beginning to end cycle. And bookkeeping is simply the recording of those business transactions, which, like I said, used to be a bookkeeper, a human person's role, and is largely almost completely automated nowadays. All right. So a ledger. There's a photo of a like a paper ledger, something that you would print out in the early days of accounting, say maybe the 1950s through the 1980s. This is a specialized accounting book, or, today would be a computer program in which information from accounting journals is accumulated into specific categories, and then they post them so managers can find the information that they need in the same place. So once the figures are correct and balanced, then you can create a trial balance. The trial balance is the summary of all the financial data in the account ledgers that ensures the figures are correct and balanced. So after that point, basically the check, you can produce financial statements and send them out to the required audiences. So the main three financial statements are the balance sheet, the income statement, and the statement of cash flows. You'll be finding and producing all three of these for your stock project report. All right, differences between single and double entry accounting. So single entry accounting is the simplest form. It's something that you would start out with when you start a small business. That means that when you have a transaction, you write it down in one location. Um, a double entry accounting system is when every transaction has two accounts. So you maintain the balance sheet equation. That means that we'll just expand on that when we talk about the balance sheet equation. And this is widely used in modern accounting and in corporate, and it's required in corporate and public accounting. Going back, I mentioned that the ledger keeps the accounts in one place. So basically, it is accumulated into specific categories and then posted so managers can find the information about one account in the same place. So we'll talk about the ledger and the posting part here in this next slide. So the steps in the accounting cycle are enumerated and outlined in the chart below. First, you take the original documents, right? You have to analyze the source. Where did they come from? What was the purpose of the transaction? And then you can sort those into groupings or into journals um, and record those transactions. So once they are recorded, you transfer or post the journal entries to the ledger. Again, in probably the last like 40 years, this has been an automated process. So once you record the transaction, it is automatically posted to the ledger. So these kind of steps two and three are sort of almost instantaneously one step in modern accounting. So once they're posted to the ledger, you can take a trial balance. I wanted to mention that when you when you take the transaction and you record it in the journal and post it to the ledger, when you do this kind of simultaneous process, um, in online accounting systems, like in corporate accounting, they'll have a cost center or a profit center assigned to them. So when you're sorting them, you're not just arbitrarily sorting them. There are specific accounts which are specific to sales revenue or to costs, and the type of cost can have its own um, it can have its own cost center. So when each type of expenditure or revenue has its own account, then it's much easier to sort and to see how transactions are posted and to check accumulated balances of each of those accounts. So when you're able to take a trial balance, then you can query just specific information that you need to check in categories. So you can check only sales revenue. You can check only recognized revenue, or you can check only travel costs incurring in a certain time frame. So once you check the trial balances, then you can prepare financial statements. This can happen on any cadence that the business requires and tends to happen at least monthly in corporate accounting. So you'll have your monthly balance sheet, your income statement, your statement of cash flows, and you'll also have a quarterly summated statement, and you'll have your annual statements. Once those statements are produced, then you close the books and then you're able to analyze the results of those statements. So there's usually a timeline when all accounting needs to be closed in order for statements to be analyzed within and outside of the company. All right. Again, I really I have to introduce technology into the accounting cycle because it is like all of these steps are largely automated. So it's even the transaction itself. Once it occurs, if you use smart software, then it takes that transaction, can automatically post it to the correct account, can immediately provide you with analytics and feedback data on how your business is doing real time. So, some accounting software such as QuickBooks, and there are so many others that are new, that are integrated, that can grow with your business, but they are extremely helpful in analyzing your position, not just at the end of the statement period, but all throughout the month. So how's the job of the traditional bookkeeper different from that of an accountant? So the bookkeeper, and again, now the automated software will take the transaction and sort it into accounts. The accountant will post it to the ledger, and then we'll continue the process from there, auditing the statement, producing the financial statements. So what is the purpose of the accounting journals and of the ledger? Again, this is to sort sales and other revenue and costs into the correct allocated area so you can produce financial statements. So how does the computer software help businesses in maintaining and compiling accounting information? Um, it has helped automate largely. It's helped with the quality of the data because it reduces the amount of human error, and it also increases real-time reporting and the condition of the business during that time period in real time. All right, so key financial statements. These help indicate the firm's financial health and its stability and can be used for decision making. Some of the key financial statements, again, are the balance sheet, the income statement, and the statement of cash flows. So a financial statement, again, is the summary of all the transactions that occurred over a particular period. Okay, on to the fundamental accounting equation. Um, the fundamental accounting equation is your assets are always equal to what you owe plus what you own. This equation always needs to be balanced. So assets equals liabilities and owner's equity. The liabilities and the equity that you have needs to always equal the number of assets. So you'll have the same number on each side of the equation. All right, the balance sheet. So balance sheet is reports the financial condition at a specific time. So there'll always be a time period showing on your balance sheet, whether it is covering a month, a quarter, a year, or some other time frame. It's a snapshot of the condition of the company during a certain time period. These are composed of three major accounts: the asset accounts, liabilities, and the owner's equity accounts. Here's a very simple balance sheet, and it's showing as of December 31st, 2016, which implies that it is an annual balance sheet. On the left side, you can see that it has assets. These are ordered in order of liquidity. For example, cash is more readily available or more liquid than inventory. Inventory also has value, but it cannot be exchanged or bought or sold as easily as cash can be exchanged. Here at the bottom, you have property, plant, and equipment, and your depreciation expenses, and any notes receivable. So your total assets at the bottom equal 8,374,000 or 8.3 million dollars because it's in thousands. So on the liability side, you can see this is what the company owes. It is also an order of liquidity. Accounts payable needs to be paid more quickly than accrued expenses. And then you have the subtotals with liabilities and with owner's equity. So as you can see, the liabilities and owner's equity is also 8.3 million, and that the balance sheet balances on both sides. Okay, so what are assets? Assets are anything that is productive and tangible, such as equipment, buildings, land, furniture, and motor vehicles. It would also include intangible items that have value. Trademarks, copyrights, and goodwill are some examples of intangible assets. Again, they're listed on the balance sheet in order of liquidity. The three main types of assets are current assets, fixed assets, and intangible assets. Current assets are items that can or will be converted into cash within the year. Fixed assets are relatively permanent, such as land, buildings, or equipment. And intangible assets are long-term, trademarks, patents, or copyrights that have no real physical form, but they do have value. All right, here's a pictorial that helps outline the difference between tangible and intangible assets. So convertibility of the asset is whether they're current or non-current. The current asset can be easily turned into cash or exchanged for cash, as in inventory that can be sold or cash that is readily available in the bank. A non-current asset would be something that cannot easily be turned into cash, such as land or long-term investments. Tangibility of the assets. If it's a tangible asset, it has a physical presence. Intangible assets also have value, but are not physical in nature. And then usability. This is whether the asset is used in the production of the product or service that is being offered. Non-operating assets are considered overhead. These have expense, but they're not directly used in creating the end result of what is being sold. So in balance sheets, services like dog groomers can use the same set of financial statements as manufacturers like Ford or even a retailer like Macy's. So consider what types of assets and liabilities a typical service business like this would carry on its balance sheet. So they may have a physical store location, they may have a mobile truck. Those would be physical non-current assets. The operational assets would be like the scissors she's using, or shampoo and bows, which are stocked in inventory. All right. Liabilities and owner's equity accounts. So liabilities are things that the company is liable for, or things that they owe, debt that they owe to other entities. So there are also three types of liability accounts: accounts payable, notes payable, and bonds payable. Accounts payable are current liabilities involving money owed to others for merchandise or services that have been purchased on credit, but they haven't yet been paid for. Notes payable are short-term or long-term liabilities that a business promises to repay by a certain date. That's when the note ends, is when the payment is due. Bonds payable are long-term liabilities that represent money lent to the firm that must be paid back. So owner's equity is the amount of the business that belongs to the owners minus any liability owed by the business. That makes sense that the owner's equity and the liabilities will equal the assets of the company own. Now, retained earnings are the accumulated earnings from a firm's profitable operations that were reinvested in the business and not paid out to stockholders in dividends. All right. So what do we call the formula for the balance sheet? Um, the what three accounts does it include? So the fundamental accounting equation is assets equal liabilities plus owner's equity. What does it mean to list assets according to liquidity? So we list them from top to bottom, according to the how easily they are transferred into cash, or how easily the asset is expendable. So cash would start at the top, and then accounts receivable, which are short-term monies that are due to the company. And things like land and equipment do not have high liquidity. They would not be as easily sold or exchanged for cash. What is the difference between long-term and short-term liabilities on the balance sheet? Similar to the assets in order of liquidity, um, liabilities um, are organized in order of the liability being payable or the debt being due. So short-term liabilities would be listed first, and long-term liabilities would be listed later on. Long-term would consist of your notes or bonds payable. What is owner's equity and how is it determined? So owner's equity, let's go back. Um, so again, those are the amount the business, excuse me, the amount of the business that belongs to the owners minus any liabilities owned by the business. All right, moving on to the income statement. The income statement shows the firm's profit or loss after costs, expenses, and taxes. This is why it is also called the P&L, profit or loss statement, or most commonly income statement. So the resources or revenue left over or depleted are referred to as net income or net loss. Net income or net loss are what's left over after all costs and expenses, including taxes, are paid. So let's look at this in a statement form. So the income statement would be the simple formula for the income statement is revenue minus cost of goods sold. So cost of goods sold translates into the direct the inventory and raw materials that directly become part of the finished good. So revenue minus cost of goods sold is gross profit. This is also called gross margin. Once you subtract the operating expenses, which you can put your employee's salary in, machine equipment, and runtime, those would all be considered operating expenses. Then you have your net income before taxes, take out the taxes, and then you have the net income or net loss if it's negative. Here is an example of a simple income statement. It says for the quarter ended 30th of September 2018. So we know that this is a 3-month income statement. Now, this company has different types of revenue. They sell merchandise. They also incur revenue from training. And then here they have a subtotal of total revenue. They also incurred expenses. They have purchasing costs, wages, rent, interest paid, transportation costs, and utilities. The subtotal for their expenses is $10,650. Then they have some gains. A gain is different from revenue. These are tied to operations. The gain is coming from the sale of a van. A loss is also not part of the regular expenses. This is a settlement cost from consumer lawsuit. Okay, so to find net income, we're going to take the revenue plus the gains, and we'll subtract the expenses and the losses. So the net income for this company for this quarter is $21,350. So what is revenue? Revenue is the monetary value a firm receives for goods sold, services rendered, or other payments. Revenue is not the same as sales. And then cost of goods sold. So that is the merchandise the firm sells, the cost of raw materials and supplies used in producing the items for resale. So if you have a clothing business, and you sell a shirt for $50. You paid $20 for that shirt. Then the revenue incurred for that shirt is $50. The cost of goods sold for that shirt is $20. And the gross profit is how much you would earn after any other expenses, paying, employees if you have any added shipping or tariff fees. And what's left is going to be your gross profit or hopefully not your loss. So some examples of revenue streams could be money coming into the business through subscription fees, advertising fees. You could sell brokerage fees. You could rent uh, or have leasing or lending businesses. You could charge a usage fee on top of whatever product or service you're offering. My closest thought here is movie tickets now have usage fees for the convenience of paying online, or sale of assets or long-term, property, plant, and equipment. So understanding operating expenses. So operating expenses include rent, salaries, supplies, utilities, insurance, and so on. And depreciation is either classified as a selling expense or a general expense, depending on how the reporting for the specific company is outlined. So again, net profit or loss is the revenue minus the sales returns, cost, expenses, and taxes over that period of time. Right. Most businesses incur operating expenses, including rent, salaries, utilities, supplies, and insurance. What are some of the likely operating expenses for companies like Starbucks? Starbucks is a franchise, and each location is usually operated by the franchisor. Some of them are owned at a corporate level, but you can purchase a franchise and open your own Starbucks. So this Starbucks picture has a physical location, right? It probably has a lease, so it needs to pay rent monthly. it probably has employees who need salaries paid too. And then utility costs to keep the lights on. They need to keep plenty of coffee beans in hand, cups, forks, spoons, packaging, and so on. All right, this is an example of revenue versus profit. Lonnie McQuarter owns a gas station that it works with local suppliers to provide customers with healthy organic food instead of the typical convenience store fare. In 2007, he took out an $875,000 loan to purchase the property and gas pumps from PB. His business now brings in about $11 million annually in gross revenue. What is the difference between revenue and profit? So he is bringing in $11 million annually. However, he operates a gas station. So we can probably assume that a large amount of this income is um, is paying for the gasoline he's supplying. So the actual profit that he's incurring is not anywhere near $11 million. All right. A statement of cash flows. So this financial statement reports the receipts and disbursements related to the firm's three major activities. This includes operating activities, investments, and financing. So what does cash flow mean? Cash flow is simply the difference between the cash coming into the business and cash flowing out. Um, this is a key consideration because companies need to be able to cover their short-term expenses within the period that expenses occur. This means that buying goods on credit can be a problem. All right, here's an example of cash flow in your personal daily life. So this individual takes home income from working a job. They make $4,500. We'll just say this is monthly. And then they have rent from the investment property that they own, and the rent pays $3,000 a month. So it's occupied. They then have a mortgage on their primary property, their home, of $1,500, and a mortgage on the investment property of $3,500. Uh-oh, looks like the mortgage is higher than the rent. Anyway, let's move on. They have a vehicle, a very expensive one, which they pay $750 a month towards. They have monthly food expenses of $500 and monthly insurance. We'll just say this is includes home and auto and any other insurance that they have on their rental properties of $400. So what we're going to do is combine the income, the 4,500 and the $3,000 together, and then subtract out the expenses, the mortgage on both properties, vehicle, food, and insurance. This gives us a net cash flow for the month for this individual of $850. Consider if they didn't have the rent from the investment property, then they didn't have the investment property, they wouldn't have the mortgage or the rent. So this would allow their net cash flow to be $500 higher in the month. Of course, that's not the only consideration, but that is one thing that we consider when looking at financial statements. Perhaps in the long term, the investment property will pay off. Perhaps the rent will go up. Perhaps he will sell the property and get high returns and no longer have the rent from the investment. So personal cash flow statement. Here's another example. So Dave and Shamron have a combined income of $4,000 a month. That is their total cash inflows. They don't have any other income or money received. So they have several expenses, including rent, cable, phone, groceries, and so on. Just the basic personal expenses that we would imagine that incurred every month. So their total cash outflows in this period are $3,370. You would subtract that from the total inflows and get a cash flow of $630. Cash flow management. So, cash flow, as we learned, is the difference between money coming into the business and money flowing out of the business. It's definitely something that needs to be closely managed, regardless of the business's size. But it's very important for small businesses that have seasonal operations or resorts. Can you think of any firms or companies that were forced into bankruptcy because of cash flow problems? Um, you may not have realized it, but when COVID hit, several companies, specifically retail and food or restaurants rather, went out of business fairly quickly because they operate on high turnover and lots of foot traffic. So they have very slim margins to pay their short-term expenses, and they have high costs for leases and building and operational costs. So when COVID hit, a lot of businesses had to just simply stop. But it didn't stop their costs from continuing to incur, and a lot of them had to go out of business as a result. Some businesses have proved to be more agile. Think of the company Spirit Halloween, how it seems to pop up in September and then disappears on the last day of October, like it was never there. This allows the company to keep its costs low by not having to lease buildings, operate rent, and pay employees 12 months out of the year when they're highly seasonal. All right, going into another statement of cash flows. This says for the 12-month period ending December 31st, 2021. So we have the three different types of cash flows, one from operating activities. We have cash flows from investing. Looks like, they might have invested in Tesla lately or something like that. Cash flows from financing activities. This is also negative. So this could be a short-term loan or, a small loan that has gone over a long period of time. Anyway, $250 to reasonably small. So their total increase or decrease in cash, it looks like they had their operating activities were able to cover the negative investing and financing activities. So they had $750 left. They started with a cash balance on January 1st of 2021. So this is for the entire year, right? So the first day they had $2,800 and $2,895. And the cash balance at the end will would include the increase in cash over the year. So 28.95 plus the 750 would equal to 36.45, which is their ending cash balance. So again, they have the starting cash balance plus the increase or decrease in cash equals the ending cash balance for the period. So what are the key steps in preparing an income statement? We talked about revenue minus cost of goods sold equaling gross profit or gross margin. And then additionally, subtracting operating expenses gets you to net income before taxes. Once taxes are subtracted, then you have your net income or net loss. What is the difference between revenue and income on the income statement? Uh, Revenue is money coming in, and the income is the revenue after costs have been taken out. And why is the statement of cash flows important in evaluating a firm's operations? The cash flows depict the short-term health of the company and its ability to cover short-term operations. Um, all right, let's talk about different types of accounting disciplines. Financial accounting is an informational analysis for people primarily outside of the organization. So outside users are interested in three questions. One, is the organization profitable? Two, is it able to pay its bills? And three, how much debt does it owe? One indicator for public companies is the annual report. The annual report is a yearly statement on the financial condition, progress, and expectations of an organization. How to read an annual report. So that typically includes management's discussion and an analysis of operations. Why were certain costs incurred? What contributed to the operational numbers? It will include the three key financial statements, the balance sheet, the income statement, and the statement of cash flows. And it also includes an auditor's opinion statement. You will need to download the auditor's opinion statement for your company that you've chosen for the stock project. So it can have one of four letters. It can have an unqualified opinion statement, which means that the company's financial statements were prepared in conformity with the GAAP, with generally accepted accounting principles, and that they fairly represent the firm's financial condition on the statement date. Most statements will be unqualified opinion statements. Some may show as qualified opinion statements. This means they've included one or more specific qualifications to its assurance that the customer's financial statements follow GAAP. This means that one or more irregularities were found, and the customer could not or would not correct these regularities. An adverse opinion. This is when the most serious of all the opinion letters that a company is, that can accompany a customer's financial statements. So this means that they've demonstrated material noncompliance with GAAP and that the CPA or accounting firm may choose to submit an adverse opinion letter to the company, the financial statements of the company under review. The last is a disclaimer of opinion. This disclaimer of opinion letter means the CPA does not assume responsibility for the accuracy of the company's financial statements. Different types of accounting disciplines under financial accounting. You can be a private accountant. Private accountants work for a single firm or a government agency or possibly a nonprofit organization. But they don't do accounting functions outside of that organization. Public accountants provide services to individuals or businesses on a fee basis. So they would have several clients that they could possibly serve. Certified public accountant is a designation for passing the CPA exam. That is a series of examinations that have been established by the American Institute of Certified Public Accountants. So, accounting disciplines need to stay up to date with different government requirements and procedures for reporting financial accounting. So, the Sarbanes-Oxley Act created several new government standards. The Dodd-Frank Wall Street Reform and Customer Protection Act increased financial regulation by increasing the power of the Public Company Accounting Oversight Board. And then the act was brought on by the 2008 financial crisis. So, under Chapter 14, under content, you'll see a video discussing what caused the financial crisis. I strongly encourage you to watch the video. The content will not be on the exam, but it's incredibly useful for understanding what happened during the Great Recession. Um, the Great the Great Recession, or the 2008 financial crisis, was the most severe economic downturn since the Great Depression of the 1930s. So it included the housing bubble and subprime mortgages, securitization and risky financial products, and excessive leverage and weak regulation. And then proceeded with an overall collapse of consumer confidence, which affected the United States and much of the world. So please watch that video after you're done with the Chapter 14 lecture. Some key provisions of Sarbanes-Oxley, which are worth mentioning, is that it strengthened the protection for whistleblowers who report wrongful actions because many whistleblowers were retaliated against in corporations for ousting their illegal practices. It also requires company CEOs and CFOs to certify the accuracy of financial reports. thus holding them accountable and imparting strict penalties for any violations of securities reporting. This used to not be the case, and the CEO and CFO could just say that they didn't know anything about it and they would have no legal repercussions as a result. It also stipulated that altering or destroying key audit documents would result in felony charges and significant criminal penalties. This act was largely due to the Enron scandal and the destroying of documents that were key in the argument against or convicting those that wrongfully altered financial statements for Enron. So ways that your company can improve accounting practices would consist of reviewing or changing current procedures to make sure that you are having consistent reporting, that your accounting agrees with GAAP standards, if that's applicable. And you can also create and expand internal audits. So if you find accounting discrepancies, or you have just a second set of eyes on the trial financial statements before they are submitted, you can also hire independent firms for consulting. This is required for public companies that they have external auditors reviewing their statements on a periodic basis. You can also restructure executive compensation plans and tie them to results in the company, but also tie them to fair policies and reporting. All right, so the other type of accounting is we have financial accounting and then we also have managerial accounting. So managerial accounting is primarily within the company. It helps with reporting for different activities within the company, such as marketing, production, or other functions. It allows the company to utilize financial statements for planning purposes, and it can check and for controlling purposes. So this can happen throughout the operational cycles and throughout the year. This is making adjustments to make sure that their costs are staying within their budget and designing strategies to minimize taxes. This can happen throughout the year, or they can have special initiatives based on how the company is doing overall and whether or not to seek out additional tax opportunities that could potentially be found in the community or with their specific type of business. Auditing, again, is simply reviewing and evaluating information used to prepare a company's financial statements. It's having a second set of eyes, if you will, and auditors will drill down to specific journal entries, to specific accounts, and to certain transactions to validate their legitimization. An independent audit is one done by an external company which provides an unbiased opinion about the accuracy of these statements. All right, tax accounting again is preparing tax returns or developing tax strategies for companies. They're primarily external and specialize in tax law and keep up with the progressive laws from year to year. Government and nonprofit accounting is an accounting system for organizations whose purpose is not generating a profit, but serves ratepayers, taxpayers, and others according to a duly approved budget. They are governed not by GAAP, but by the Governmental Accounting Standards Board. All right, so the key difference between managerial and financial accounting is managerial accounting is primarily intended for the internal audience, for controlling functions, and for internal reporting. And financial accounting is primarily externally focused. How is the job of a private accountant different from that of a public accountant? So private accountants are internal to a single company, and public accountants work externally, usually for several types of uh, for several businesses, as opposed to within a single firm. So what is the job of an auditor? What is an independent auditor? Audits. Auditors check the processes and procedures in which the company operates conform to specific standards as outlined by company mandates. I hope you guys enjoyed chapter 14 and that you were able to fill in your study guide. Make sure to submit it before the due date. Thank you.